Welcome to the B.F. Anderson Technical Report for December the 13th. The hit ratio, great tool, straight out of Peter Lynch's book, One Up on Wall Street. The theory is this, and the concept is this, that if you're building a portfolio and you're getting hit with failures, in other words, you invest in a stock, it goes down, that's not what we want to do. And the reality here, the hard reality is that with trend following, if indexes, and we follow 5 indexes, if these indexes are in downtrends, 4 out of 5 stocks will fail. You just can't seem to get things going. So the hit ratio is very simple. As you feel the market is trying to bottom and you're starting to see signs of an upturn, one of the best things to realize is that, okay, I'm going to buy 10 stocks, I buy 1, I buy 2, I buy 6 stocks, and you're hitting 50%. So you're getting 3 stocks that are doing well, 3 that aren't. So you get rid of the 3 that aren't working out. But you want to have a hit ratio that's north of 50%. Well, fortunately, right now, as we've been slowly nibbling on a couple of ideas, we're now at 100% hit ratio. So as you know, if we start to see improvement in the market and our hit ratio continues to stay above 50%, you continue to move forward. So it's a great tool. Any questions about it? It's really worth looking at. So let's get into the charts here real quick. This is the NASDAQ composite. We look at the NASDAQ first because it's the most important index. It's a big index, a lot of stocks. More growthy, kind of gives you a little bit more of what's going on with growth. Now, as you can see, you know, starting back in September, October, we started a downtrend. We are still in a downtrend. As you can see here, the 25-day moving average is continuing to move down. The 50-day moving average is also in a downtrend. So it's in a downtrend. We call it a bear market, whatever you want to call it. I just prefer to call it a downtrend. Now, if you notice volume here, we have been getting some rallies, but the rallies are coming on fairly light volume. We're not getting, you know, 3 billion, 3.5 billion. Shoot, I'd love to see about a $10 billion day where the market jumps 3%. I mean, it's just not out of the question. But right now, we are in a downtrend. Volume is somewhat anemic. Now, here's the weekly graph. Again, the weekly volume is hard to read because of all the holidays, but we continue to stay below the 35-week moving average. We're not breaking above it. We'll get up and somewhat kiss the moving average and pull right back down again. So on a weekly basis, things really don't look all that good either. Now, there is some good news here, and it seems like the number of new 52-week lows, and we're starting to see some 52-week highs in some growth stocks. Now, as you remember, this is the high-low index where we take the number of new highs divided by the number of new highs plus new lows, and we want to see this indicator get back up into this range here, above 30. And we're starting to turn up, so that's good. And we're making a higher low than the prior low. So maybe things are starting to improve. Now, on the number of new lows on the New York Stock Exchange, just a couple of days ago, I mean, we were getting, 560 new lows a day, over 600. Actually, several days ago, we got the highest number of new lows we've seen in a long time. Now, this could be indicative of a washout where we're finally just getting all the sellers out of there. Yesterday, we only had 67 new lows, but then again, I must emphasize, for this market to be healthy, and we call this the leaking boat indicator, because if you're getting more than 40 new lows a day, you may not be in a bear market, but the boat sure is leaking. So what you want to see here is a consistent pattern of the number of new lows drying up to less than 40 a day. We're just not seeing that yet. Now, on the long-term graph, which is the 10-20, this is the 10-month moving average compared to the 20-month moving average. Now, I got this indicator from Louise Yamada, who's a top technical analyst, smart lady. The problem we're seeing right now is that we've gotten a drop below the lower moving average. The upper moving average is now starting to turn down, and we just don't want to see a cross. But it is holding here. Now, on fear greed, and this is really important because we want to know that what's going on out there with optimism and pessimism. We're still in extreme fear. The latest reading on the fear greed index on the attached email is around 11, which is about as low as it gets. But we are seeing a little bit of a turn here, but we're still in extreme fear. Now, my greatest concern right now is the fact that the small cap index, which is the S&P 600 small cap index, you could also use the Russell 2000. These are the small companies. This is the riskiest part of the market. In other words, the small companies. So the fact that it has broken down so dramatically and is way below the lower moving average, and the lower moving average has turned down. Anyway, this is a concern of mine. Now, another concern of mine is the financial stocks, the bank stocks. They really took a hit this week. They've broken down below prior lows, have failed to rally back above those lows. The bank stocks are just not looking good. Like here is J.P. Morgan Chase, just as one to be aware of. This is probably the safest, top bank in the country right now, if not the world. And its stock took a big hit as well. So the bank stocks are bothering me. Without the bank stocks, there's going to be a lot of uncertainty. Now, back to just understanding the long term here. Now, you're going to have what I would define as easy years. If you get a sideways year like this, I would define that as easy. This would be an easy year. And then you get down years, downtrends. These are difficult years. So, you go back here and look at 08, look how difficult that was. You're going to have easy years and you're going to have difficult years. And so as you take this 20-year pattern, you see that you had 8 years that were difficult and you had 12 years that were easy. So during those 12 easy years, you really needed to pay attention to your portfolio, because that's where you were going to make your returns, so that when the difficult years came along, you were able to deal with them because you had a cushion. Now, as you can see, the big problem is the U.S. economy really started to turn bad about 20 years ago, and the market has been trapped in a box for approximately 20 years. And we have pulled back into the box, not dramatically, but we have pulled back into the box. Now, this is really, in a way, very bullish, because I can remember starting in the business in 1976. The market peaked in 1966 at 1,000. The Dow was at 1,066. Dropped dramatically in the 74 recession, made a low, and then started, just like we have here, made a low and started to work its way back up. And we did not break out above 1,000 again until 1982. And then we went from 82 to 2000. We ran for about 18 years. It was just a fantastic period to be in the market. Well, the longer the base, the greater the race, which means that as people have gotten so disenchanted with the stock market over the last 20 years that they're doing other things with their money. And so what happens is that builds up fuel, so that if this thing does start to straighten out and breaks out into an uptrend, you've got a ton of cash that can come into this market. So this is not necessarily bad. So the main thing to also realize here is that during these downtrends, this is where you see the strongest companies. In other words, when everything's going up, it's very difficult to differentiate which companies or which stock prices make the most sense. So the good news here is that when you're in a downtrend like we are right now, look for the companies that are having what we call strong relative strength. You want to see relative strength here. Now, on the top 5, and again, I want to emphasize here, top 5 is nothing more than a relative strength analysis where we're looking for what stocks are holding up in this environment. Now, these are not researched companies. These are just companies that we're seeing on our list that we may do research on in the future if we continue to see strength. Now, the interesting thing about the watch list this morning, and I think this is very important, the entire top 5 are technology stocks, which is really a good sign. And a lot of these are small cap. So I mentioned earlier I was worried about the small cap index. Maybe we're starting to see a turn here. So this is Alteryx Technology Software. Stock is in an uptrend, looks good. Here is Tableau Software, another software, in an uptrend, just made an all-time new high. Here's a company called Twilio. Now I must disclose, we own this stock. This is an interesting company. We have researched this thing quite extensively, and it has to do with a communications network called Chat. So if you go to my webpage, for example, in the bottom right-hand corner, you're going to see a feature where you can chat with us over our webpage. This is really an interesting technology, and I think everybody is going to go to this with their web pages. Here's another software company called Workday. Recently hit an all-time new high and is in an uptrend. Now, here's another company that we have owned recently, but decided to let it go just because of the market conditions. This is called Xilinx. They are a semiconductor manufacturer that is involved in 5G technology is the main reason I'm interested in it. They also do data center technology and so forth. You know, kind of like an NVIDIA, but hopefully we're early on it. It is one to keep an eye on. So all in all, what I'm saying is the market is in a downtrend. Use the hit ratio as a way to build your portfolio. In other words, fools rush in, and on Wall Street, that's a disaster. You nibble, and if you're successful, you nibble a little more. If you're successful, you nibble a little more. So if you have any questions, give me a call. Thank you very much.